Let's look now at preparing the operating activity section using the direct method this time. So here's a template for preparing the operating activity section using the direct method. And what we're going to have to do is come in here and calculate our inflows of cash and our outflows of cash through a series of adjusting items. So we're going to convert each line item on the income statement from accrual to cash basis. So in effect, the operating activity section of the direct method statement of cash flows is really just a cash basis income statement. So depreciation, depletion, and amortization expenses do not require the payment of cash and therefore are not going to be reported on our direct method statement of cash flows like they were under the indirect method. And gains and losses from the sale of fixed assets again do not represent cash flows. The cash flow related to the sale of a fixed asset is going to be equal to the proceeds from the sale of the asset. As with the indirect method, the proceeds from the sale of the asset are reported in the investing section, not the operating section. So here's kind of, again, like a little mini cheat sheet that you can use to help you calculate these various sections. So in order to determine the cash receipts or collections from customers, we first start with the income statement account, which is sales revenue here. And then we would add any decreases in accounts receivable or subtract an increase in an accounts receivable. And then we would add any increases in unearned revenue, which is a liability, or subtract decreases in unearned revenue. To convert interest revenue into interest received, we start with interest revenue from our income statement, and we adjust it by the computed increase or decrease in interest receivable. So a decrease in interest receivable is going to be added to interest revenue, and conversely an increase is going to be subtracted. And then to convert dividend revenue into dividends received, you start with dividend revenue and adjust it by increasing or decreasing dividends receivable. You've got a decrease in dividends receivable, which would be added, or an increase would be subtracted. We have a few more here to look at. So payments to suppliers would include a two-part computation. So we have to look at first payments for inventory and then payments for operating expenses unrelated to employees' interest or income taxes. So to convert cost of goods sold into payments for suppliers, we start with cost of goods sold from our income statement, and it's adjusted by the computed increase or decrease in inventory and accounts payable. So an increase in inventory, which is an asset, is going to be added to the cost of goods sold, and a decrease would be subtracted. A decrease is going to be subtracted in accounts payable. Decrease in accounts payable gets added here, and an increase is going to be subtracted. Then we move on to our payments for operating expenses, which sometimes relate to prepaid expenses like insurance, supplies, or rent, and other times are related to accrued liabilities like property taxes payable. So if the expense has a prepaid associated with it, we add an increase or subtract the decrease in the prepaid expense item from the income statement account. If the expense has accrued liability associated, we add the decrease in accrued liabilities or subtract the increase. So you can see why people prefer the indirect method probably here. It's just a little bit easier overall. Okay, and then we can look at employee expenses and how we convert those into payments. Start with salaries expense, for example, and we adjust that by the computed increase or decrease in the salaries payable account. So a decrease in salaries payable would be added to salaries expense, and an increase would be subtracted. Now to convert interest expense into payments for interest, interest expense is adjusted by the computed increase or decrease in interest payable. So a decrease in interest payable is going to be added to interest expense, and conversely an increase is going to be subtracted. And to convert our income tax expense for income taxes, income tax expense is adjusted by the computed increase in income taxes payable or decrease. So a decrease in income taxes payable is going to be added to income tax expense, or an increase is going to be subtracted. Let's look at an example here. Now this is kind of a cheating example because they've already calculated for you here those receipts from customers and receipts from sale of land, but you can kind of see easily how the statement then is going to go ahead and be prepared. So what I like to do is kind of outline which one are operating activities, which one are investing, and which one are financing activities. So the first one, receipts from customers, that's going to be operating activities. Proceeds from the sale of land, or receipts from the sale of land, here is going to be an investing activity, and receipts from stock issuance will be financing. So we've got operating, investing, and financing under the receipt side. Let's look at the payment side. So the payments for merchandise, wages, interest, and taxes are all going to be operating activities. We need to do all three of those in order to operate our business. Payments for equipment will fall under the investing section. And finally, the financing section will include payments for bond retirement and payments for dividend. So then we can just go ahead and take that information and plug it into our statement of cash flows. We'll go ahead and list out the cash received from customers, which was in operating activities, and then the cash paid for merchandise, wages, interest, and taxes, which is also for operating activities. Take all of those items, add them together, we get cash provided from operating activities, $141,000. Then we had sold some land at $25,000 and purchased some equipment. Add those two together, that results in net cash used by investing activities of $45,000. And cash flows from financing. We did have proceeds from the issuance of stock of $35,000. And then we redeemed some bonds and paid some dividends, so that resulted in an overall net cash used by financing activities of $155,000. Now add all three of those together, and that gives us a net increase in cash of $41,000. Added to our beginning cash balance, and then our ending cash balance is $63,000 overall.